a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
There seems to be a proliferation of zero-fee ETFs on the market or coming onto the market, and we're going to find out why with our ETF Research Director, Nina Mishra, who joins me now. So it's like a race. These firms are having a race with each other.
The race to zero.
Yeah.
So investors are becoming increasingly cost conscious.
Okay.
So that is why ETF providers are in this race to win more investor cash by lowering the fees.
Okay.
So 70% of ETF assets are in products that charge 20 basis points or less. And in fact, 93% of new money this year went into these kind of ETFs, these cheap ETFs. This is according to Bloomberg data. And there are 5 ETFs and ETNs that have either zero or negative fee. That means either they don't charge you anything or they pay you to invest.
Okay.
And the new front-end fee war is in commissions. So last month, Charles Schwab announced that they are reducing commissions to zero.
Yes.
In fact, Interactive Brokers announced even before them. And so other major brokerages, they had to match that, otherwise, you know, clients
competition.
Exactly. So then this move was followed by similar moves by TD Ameritrade, Fidelity, E-Trade, and Vanguard already had commission-free tradings for almost all ETFs. And then there's Robinhood, which is a platform which millennials usually like a lot.
I thought he robbed from the rich and gave to the poor. Oh, it's a different thing. Okay, sorry.
So that app also has commission-free trading. They are very popular with millennials, as I mentioned. So, but there are implications of these zero fees and zero commissions.
Sure, mainly because firms need to make money somehow.
Yeah, these are not charitable institutions. These are for-profit companies, so they will try to make money. And in fact, impact is not much for Charles Schwab because commissions are a small part of their total revenue. For companies like TD Ameritrade, the implication is more because commissions were a large part of their net revenue. So how they may try to make money, brokers can earn a lot on the idle cash in your account. Many investors do not pay attention to how much, like 20, 30,000 or even more than that cash which is sitting uninvested in their account. So brokers use that cash and they use it for various purposes and make a lot more, and they pay you very little on that idle cash. Then there are some brokers which sell your order to other third parties. That is, and Fidelity says that they are not going to use that. They are not going to do payment for order flow because of the zero commissions, but there are other brokers who may still do that. And when your order goes to third parties that pay maximum amount, the best bid for those orders, then you may not get a good price for your order.
For the transaction. That's what we typically have known to be the trailing commission fee, right, to the institution.
Yes, yeah, the bid-ask spread may be larger, so that is why your trading costs may be higher. Another indirect implication of these zero commissions is that investors may think, oh, there is no commission, so let's trade 10 times a day.
Yeah, right.
Because when the commission was like $5, $6, $7, you pay something, so that inhibits you from trading too much.
Right.
And particularly ETFs are meant to be held for a longer time, except for leverage and inverse ETFs, which are used as trading tools. Other ETFs are usually meant for core holdings in the investors' portfolios. So that is why investors, in fact, no one can time the market correctly. So too much trading actually hurts performance. That is what research has shown. And then if you trade too much, there may be capital gains too on the positions.
Yeah.
On the positions that have, that are in profit.
Bottom line is there's still no free lunch.
Exactly.
When it comes to investing.
Yes.
Or making money in the market, right? All right. So you've got a list of products here that are zero-fee exchange-traded products.
Yes, I said exchange-traded products because 3 of them are exchange-traded funds and 2 are exchange-traded notes. Now, in this episode, we are not going to explain the difference between notes and funds,
right.
but because we have done it in separate, that requires a lot of time. But so I just wanted to quickly go through these. Now, the first one is a negative fee product. It's called the SALT Low True Beta US Market ETF with the ticker symbol LSLT. This has an expense ratio of 29 basis points actually, which has been waived. And not only waived, the provider will pay you 5 basis points, which is or $5 for every $10,000 investors, which is basically very little, till April 2020 or till the fund reaches 100 million in assets under management.
Whichever comes first.
Whichever comes first. And after 1 year, which is in May 2020, the expense ratio may go to 29 basis points. Investors should remember that. If you want to take a look at this ETF, you can go to the quote page on Zacks.com. And from there, you can go to the external home page also, SALT Financial, and take a look at the holdings and other details. And as I mentioned, it has a negative fee as of now, but that may change.
Okay.
Then the online lender, mainly student lenders, SoFi, they have a couple of ETFs which have a fees of 19 basis points each. SoFi Select 500 ETF with the ticker symbol SFY, and SoFi Next 500 ETF ticker symbol SFYX. 19 basis points each, which has been waived for 1 year. And again, the fee may go back to 19 basis points, or they may reduce again, who knows. So that is something investors should keep in mind if they want to consider these ETFs. And again, to take a look, you can go to the quote page, and from there, the external home page. This would look very much like S&P 500 ETF with a growth tilt. But as I mentioned, remember that the fee may change. Then recently, we saw the launch of 2 ETNs, exchange-traded notes, which are actually zero fees. That it's not through waiver. They will not. They don't charge any fee. It's the first one tracks the performance of gold, a ticker symbol GBUG, and the second one tracks the performance of silver, ticker symbol SBUG, silverbug. Now, the problem which I see with these products is that they are exchange-traded notes, so which they have their problems of their own, credit risk of the issuers. I wouldn't say Barclays has a lot of credit risk, but that's something investors should remember. And then, as far as precious metals are concerned, these would have some tax advantages, but people who want to invest in gold and silver, they usually prefer physically backed gold and silver ETFs. They like to hold funds which actually hold precious metals in there. Also, that is something investors should remember. These don't hold anything. They just promise to match the return of silver and gold.
But the cheapest ETFs that investors should consider are what?
So yes, don't bother about zero fees, which, as I mentioned, those ETFs which charge zero fees as of now, their fees may go back to much 29 or 19 basis points. And you may not get the liquidity. So when you trade those ETFs, your bid-ask spread may be much larger. So that is why investors should consider these ETFs, which I really like. They charge just 3 basis points, which is $3 for every $10,000 invested, which is basically, I think, free. So let's take a look at these ETFs. VOO by Vanguard is the cheapest S&P 500 ETF, and you can go to the external quote page. So obviously it's a S&P 500 ETF, so what you would get is Microsoft, Apple, Alphabet, Amazon, Facebook as top holdings. Now the other one by iShares, this is if you want to your ETF to hold other stocks too, mid cap and small cap stocks too. Probably you should take a look at this one. So this is iTotal by iShares. Nice dividend yield of 1.9%, and you can go to the external home page to learn more about this ETF, look at the portfolio and other details. So again you will get Microsoft, Apple, Amazon, same company, because it is also a market cap weighted ETF. But in addition to your these large cap companies, you will get exposure to smaller companies too. So basically you will be holding the entire market by holding this particular ETF.
All right. Now, do you own either of these that you've talked about?
No, I do not.
Okay, thank you for that. I'm sure you'll keep an eye on things and let us know if the situation turns around with these no-fee ETFs. And in the meantime, there's always more ETF information on our website, Zacks.com. Funds tab in the top toolbar on the homepage will help you get you there. Also, Nina produces a weekly ETF Spotlight podcast where she tackles a lot of interesting information in the ETF world, stuff that she just doesn't have time to talk about in video form here. You want to go to the podcast section of Zacks.com, use the podcast button all the way at the bottom of the homepage to help get you there. Here's something else that you may want to consider if you haven't already. For a limited time, you are invited to follow market insights from Zacks, buys and sells from all of our recommendation portfolios. And you can do that in real time. And the best part is it only costs $1 for that opportunity. So if you haven't taken advantage of that yet, that's something that you may want to consider. And all you need to do to do that, to take advantage of that, is go to Zacks.com/promo, and you can even see into some of our services that have typically been closed to outsiders and only open to subscribers. So might be a good opportunity for you to consider. Meantime, with Nina, I'm Terry Ruffalo.